You walk into a bank, or you open the app, or you apply for something, a loan, a credit card, a better account, and in your head, you're just a person trying to manage their money. But the bank isn't seeing a person. They're seeing a number, actually several numbers. And based on those numbers, they've already decided what you deserve, what you'll be offered, and how much it's going to cost you. You just don't know what those numbers are, or how they work, or that two people can walk into the exact same bank on the exact same day and walk out with completely different deals. Different interest rates, different limits, different treatment, based on information the bank has about them that neither person fully understands. That's what this video is about. Not how to use a bank, how a bank uses you, and more importantly, how to make sure you're on the right side of that equation. Here's what the bank actually sees. When you interact with a bank, any bank, they are running a silent calculation. It happens instantly, it happens every time, and it determines everything about how they treat you. They call it risk assessment. What it actually is a ranking system, and you are being ranked whether you know it or not. The ranking is based on 4 things: your credit profile, your income and employment stability, your existing relationship with money, meaning your account history, your balances, your behavior, and your net worth or assets. Most people only think about the first one, and that is exactly why most people stay stuck at the bottom of the ranking without ever understanding why. Level 1. You are a risk. This is where most people start. And honestly, this is where most people stay without realizing it. At level 1, the bank sees someone whose financial behavior signals uncertainty. Maybe the credit score is low or thin, meaning there's not much history. Maybe income is inconsistent or hard to verify. Maybe there have been overdrafts, missed payments, or accounts that went to collections at some point. None of these things make you a bad person. Most of them are the result of circumstances nobody warned you about. But to the bank, they are data points. And the data points say, this person is a risk. So here is what the bank does with a level 1 customer. They charge you more. For everything. The interest rate on your credit card is higher. The loan terms are worse. If you qualify for a mortgage, the rate is higher than what someone with a better profile would get, which means you pay tens of thousands of dollars more over the life of the loan for the exact same house. They offer you less, lower credit limits, smaller loan amounts, products with more restrictions and fewer benefits. And in some cases, they quietly make money off your struggles. Overdraft fees, late fees, monthly maintenance fees on accounts that wealthier customers get for free. The less money you have, the more fees you pay. That is not an accident. That is a business model. Level 1 is expensive. And the cruelest part is that most people at level 1 don't know they're there. Level 2. You are a customer. At level 2, the bank sees someone who is stable. The credit score is decent, somewhere in the good range. Income is consistent and verifiable. There are no major red flags in the account history. You pay your bills. You don't overdraft. You show up as reliable. This is where the bank stops seeing you as a risk and starts seeing you as a customer worth keeping. And the treatment changes noticeably. You qualify for better products, credit cards with actual rewards, cashback, points, travel benefits, loan rates that are competitive, mortgage terms that don't quietly punish you, accounts with no monthly fees or easy ways to waive them. The bank will start marketing to you, offering you things, because now you represent revenue without risk, and that is exactly what they want. But here is what level 2 customers almost never realize. They think they have arrived. They think decent is good enough. They are comfortable. The fees are manageable. The rates are fine. What they don't know is that there is a level 3. And the difference between level 2 and level 3 is not just financial. It is a completely different relationship with the institution. Level 3. You are an asset. Level 3 is where the bank stops treating you like a customer and starts treating you like a partner. This is not about being rich. It is about being the kind of financially structured person that banks actively want to do business with. High credit score. Not just good, excellent. Consistent high income or significant assets. A long, clean financial history. Multiple accounts or products with the same institution. Low debt relative to income. At level 3, the bank comes to you. You get access to products that are never advertised publicly. Private banking services. Wealth management. Loan rates that are significantly lower than what the average customer sees. credit limits that feel almost unlimited, dedicated account managers who actually pick up the phone, and the fees? Almost non-existent. Because banks don't charge their best customers fees. They make their money on the relationship, on the investments, the mortgages, the business accounts, the long-term value of someone who is building wealth and will keep building it. Level 3 customers cost the bank almost nothing and generate significant revenue, so the bank treats them accordingly. The question is, how do you get there? How to move up the levels. Here is the uncomfortable truth about the banking system. It is designed to keep level 1 customers at level 1, not through malice, through friction, through the simple fact that bad financial history is expensive to escape, and expensive history makes it harder to build better history. But it is not a locked door, it is a slow door. And once you understand what moves it, you can start pushing. The first thing that moves you up is your credit profile. Not your credit score in isolation, your full credit behavior. Payment history is the biggest factor. Every single on-time payment builds the profile the bank wants to see. Every missed payment sets it back months. If your score is low, the fastest legitimate path upward is a secured credit card or a credit builder loan. These products exist specifically to create positive payment history when you don't have any. They are not glamorous. They work. If your score is decent but not excellent, the focus shifts to utilization, how much of your available credit you are using. The bank wants to see that number below 30%. Below 10% is even better. That means if you have a $1,000 limit, carrying a balance above $300 is quietly hurting you, even if you pay on time. The second thing that moves you up is your relationship with your own accounts. Banks look at your behavior. Overdrafts signal instability. A checking account that regularly hits zero signals risk. An account that maintains a consistent balance, even a modest one, signals reliability. You do not need to be wealthy to look stable to a bank. You need to be consistent. Same income coming in, bills going out on time, a balance that does not regularly disappear. That pattern, maintained over 12 to 24 months, changes how the bank sees you more than almost anything else. The third thing that moves you up is your debt-to-income ratio. This is the number most people ignore and banks obsess over. It is simple. How much of your monthly income goes to debt payments? If you earn $4,000 a month and your minimum debt payments total $1,600, that is a 40% ratio. Banks consider anything above 36% a risk signal. Above 43%, and many lenders will not approve you for anything significant, regardless of your credit score. Paying down existing debt, even slowly, even $50 extra a month, moves this ratio. And moving this ratio moves you up the levels faster than almost anything else you can do. The fourth thing is time. There is no shortcut here. Banks reward financial history. A thin file, meaning not much history, is treated almost as poorly as a bad file. The answer is to start building that history now. Keep it clean and let time do what time does. 2 years of consistent positive behavior will change your profile more than any financial hack or credit repair service ever could. What this actually means for your life. Here is why this matters beyond just getting approved for things. The difference between level 1 and level 3, in real dollar terms over a lifetime, is staggering. A level 1 customer buying a $300,000 home might pay an interest rate 2 full percentage points higher than a level 3 customer. Over 30 years, that difference is over $130,000. Same house, same bank, different level. A level 1 customer carrying $10,000 in credit card debt at 29% interest is paying nearly $3,000 a year just in interest. A level 3 customer with the same balance at 16% is paying less than half that. Same debt, different cost. A level 1 customer pays monthly fees, overdraft fees, and transaction fees that a level 3 customer never sees. Small amounts, but over years, thousands of dollars that went to the bank instead of toward building anything. The banking system does not create these differences to punish people. It creates them because it is a business, and risk costs money. But the effect is the same regardless of the intention. The people who need financial help the most pay the most for it. And the people who need it least pay almost nothing. Understanding this changes how you make decisions. It changes what you prioritize. It changes how urgently you treat your credit profile, your account behavior, your debt ratio. Because you are not just managing money, you are managing your level. And your level determines the price of everything. Where to start this week? If you do not know what level you are currently at, find out this week. Pull your credit report. You are entitled to one free from each bureau annually. Look at your score. Look at what is on it. Look at your debt-to-income ratio. Do the math honestly. Then pick one thing. Just one. If your score is below 670, open a secured card or credit builder account and make one small purchase a month that you pay off in full. If your score is between 670 and 740, focus on utilization. Get your balances below 30% of each limit. If your score is above 740, focus on the relationship. Consolidate accounts. Build history with one institution. Negotiate better rates on existing products. You have more leverage than you think. The bank already knows your level. It is time you knew it too. And once you know it, you can change it. Anna Investment is here every step of the way.